Good afternoon. I'm Steve Lawrence, head of Quantextual Research at State Street Global Exchange, and thank you for joining us for this Shark Tank session. This session, if we do our jobs right, is going to be like an improv comedy theater. There's going to be some jokes, but they're going to be a little nerdy. There may be some equations, but I promise you won't have to memorize anything. But the main reason this is going to be like improv theater is it's going to be almost entirely unscripted, and there's going to be a significant amount of audience participation. I want to get you guys involved in this. Another reason this is like improv theater, thinking of whose line is it anyway, we're going to be keeping score, but much like whose line is it anyway, the points don't matter. In fact, the points are a little bit like the meal that they serve you on a flight from the US to Australia, and the name that they call it. I mean, they call it supper or breakfast, but if it's served at 3 o'clock in the morning, it really doesn't matter. It's just food when you should be asleep. But we are going to declare a winner at the end of this, and that winner will rightly be able to walk around the city for the rest of this conference, proudly saying that they entered into the Shark Tank and came out on top. So in front of you today, you have 2 academic papers full of equations, tables, and dense academic language. And you have a Brit by way of America who currently thinks that it is 1 o'clock in the morning. So I am going to need your help to rescue me from my slumber. And that's going to mean that I'm going to need you to engage both your brains and your mouths as we go through this session together to really get a sense of what the value is in academic research. This is going to be a collaborative effort. I'm going to want you to have conversations among yourselves at your tables about the ideas that we're looking at. And at the end of this, we're going to hopefully have a greater sense of what it means to look at academic research and to find value in the ideas that come out of academia. Now, I also want to point out that there's really no wrong answer here. I want you to feel comfortable to share ideas and to bounce ideas off each other without worrying about whether or not the answer makes sense or not. The only time you need to worry about giving a bad answer is if you do decide to come up and pitch your idea to the Sharks, which is going to be myself and David Hartley, who I'll introduce in a second. If you do that, you can expect, if you come up with a bad question or bad answer at that point, you can expect that the Sharks will lay into you. But otherwise, please feel free to engage in conversation without worrying about the outcome. Now, before I go any further, I want to ask you about a question on academic research. I also want to let you know that the AXA IM live Q&A is now open and will be for the duration of the session. But if you can take out your mobile devices, I'm going to put up the first question here. And this would be the polling question number 1 on the app. And the question is, how much do you utilize academic literature for new investment ideas? Not at all, occasionally, regularly, or all of the time? So I'll give you a couple of seconds to answer that on there. As we're doing that, I want to point out to you that we do have materials on the table. We're going to get to the interactive session in a bit. But just to give you an idea of what you have on the table, you have a worksheet that you can fill in yourself. This has got spaces in to fill out the answers, and we're going to work through this together. You have notes prepared by one of our top researchers on the paper at your table. And for those of you who are overachievers, we actually have copies of 1 copy per table of the paper. So you can be the one that goes in and finds a statistic on page 47 and uses that as the sole basis of your argument for your Shark presentation. So we've got the results in now. It looks like most of you are occasionally reading academic research. Now, occasionally means I'm really not reading it that much, but I don't want to admit that I'm not reading it at all. But the fact that we actually have some people regularly and all the time reading it is actually quite remarkable in my mind. Because if you're thinking about academic research, it's hardly what you call a page-turner. You're hardly reading academic research because you want to be entertained. I've never heard somebody say, I went to the beach and I read a great academic paper on vacation. And I've never heard anybody willingly say, I woke up this morning and had breakfast while debating quality minus junk or geographic momentum. And I say willingly because some of my colleagues here from State Street were dragged out of bed at the ungodly hour of 7:30 in the morning to engage in a pre-session training to make sure that we were all on the same page on this. And that's one thing that I want to point out. This is going to be interactive. I'm here to help work you through this, but I've got some of my colleagues interspersed throughout the audience who are going to help sort of engage the discussion. They've taken the time to read the paper in advance, so they're going to be your guides in some respects, but I still want you to look into these ideas yourself and really come up with as much as you can on these ideas. So the question is, why are we reading academic research at all? What is in it for ourselves? If we can just go to my first slide. I'll just go back to the slides. Academic research, it may not be that it contains a complete recipe for an investment strategy. And it may not be that you're even interested in having a complete research strategy and recipe given to you. Your investment mandate may be that you don't actually care about coming up with an active quantitative strategy. You may just be interested in insights. But what academic research provides us with is the building blocks. It provides us with the ingredients or the techniques to help us build a more robust investment strategy. It gives us insights that help us to innovate and push our knowledge of financial markets forward. But besides the depth and the boring nature of academic research, there's one other major reason why we don't read as much academic research as we can, as we should, and that's just the sheer volume of research, the inability to keep up with it. I was the only researcher at my PhD program that willingly went into industry. The rest of my cohort went into academia to become professors. And as much as I am jealous of their lifestyle of waking up midday, strolling in for afternoon lectures and office hours, and also spending half the summer hanging out at resort locations at conferences, although it's kind of pot calling the kettle black this week. The one thing that always struck me, the one thing that always scared me away from academia was this mantra of publish or perish. And all of my fellow PhD students are currently in an environment where, in order to be seen as successful, in order to be doing their job as professors, they've got to continually write papers and hopefully get them published. And so when you combine an entire industry of professors in the social sciences, in economics, in finance, you end up with 65,000 papers published to SSRN on an annual basis. And if you think about that, if you want to put that another way, that's the equivalent of 3 boxes of photocopier paper every single day produced by academics. Now, I can tell you, even if you have a laser-like focus and dedicate your efforts to just reading academic research, there's no way you're even going to get through the first box in a day. There's just too much research. And so the question is, how do you actually get through all of this information? How do you find insights when there's just so much of it? And the answer is, and this is something that I've been thinking about for a while, you achieve it with a combination of discipline, teamwork, and increasingly technology. And I'm going to talk a little bit at the end about the technology parts. As part of my team of Quantextual research, we're combining machine learning and human expertise to really tackle this information overload problem head on. But for this session today, we're going to focus on those first 2 parts, what we can learn as a team and what we can learn through discipline and actually understanding how to tackle research efficiently. So I've already wasted about 5 minutes of our time, but I want to give you an overview of how the session is going to go. We're going to learn a little bit about how to read research. I'm going to give you a couple of pointers that will help you in the main part of this session. The main part is this 20-minute session in the middle, where we're actually going to turn into the tables and actually take a look at one paper and go through answering some of these questions and understanding the key features of an academic paper. Then we're going to go over to the challenge section, the Shark Tank, where 2 of you are going to come up here and are going to each take one of those papers and pitch it to the Shark Tank. And the idea there is going to be to really put this idea through its paces. And then we're going to vote. We're going to pick a winner, and we're all going to go home either with the glow of victory or the pain of defeat. You guys with me? Okay, excellent. So let me go through 3 key steps for understanding academic research. My team has been reading academic research on a rigorous basis for about 6 years now, and we go through somewhere between 1,000 and 1,500 papers a quarter. Now, that's not reading every single paper cover to cover. There's no way you can do that. But we have these 3 techniques that we use to actually help us with this. We call them literature scan, deep dive, and the Shark Tank. And each of them has a different purpose in helping us to get from an overwhelming volume of research down to papers that we're interested in, to deep knowledge, and then really battle testing those ideas. So I'm going to talk you through each of these pieces as we go along. The literature scan piece is about refining the idea, about figuring out which papers you want to read. Now, for the purposes of today, you can assume that the papers in front of you are already relevant. You don't need to worry about whether or not you want to read this paper. You're going to have to read what's in front of you anyway. The deep dive is once you've actually figured out a paper that you're interested in, how can you get more out of that research? How can you efficiently tackle a 60, 70-page document and get insights without having to read it from cover to cover? Which frankly was my approach before I really got into this. I, as a PhD student, would take 2 weeks to read a paper because I'd start on page 1 and work my way to the end, trying to prove every single equation along the way. And meanwhile, my professors were giving me anything from 10 to 20 papers a week to read. There's no way that I was going to keep up. But you finally learn this technique of how you tackle a paper in increasing detail, only focusing really detailed on the papers that you're most interested in. But then the third part, the Shark Tank, is really a key critical thing. It's something that we don't often do as finance professionals. And that's really to take an idea and to throw it against each other and to really sort of tear it down. It may not be my idea, but if I go and ask you for your opinion on it, we can maybe together figure out what is wrong with it or what is right with it. So let's take a quick crash course in speed reading. Now, I don't want to lecture you like a primary school English teacher, but really the idea here is to just focus on the key themes, to focus on the areas where you know you're going to find insights. And so the first part is really just about figuring out whether or not you want to read the paper to begin with. Is it even relevant? Second part is to figure out, where are we going to look for the key insights? You may want to just read the title and decide whether or not the paper is relevant just based solely on the title. Or you may want to, if you read the abstract, you can get a little bit of more insight into it. We probably throw away somewhere between 50 and 60% of the research that comes across our desk just based on the title and a good sense of whether or not it's going to be relevant. There's a lot of good research out there to be read, and we don't have time necessarily to read through every single piece. But you can do a good job by filtering intelligently before you sit down. And that's where, again, where technology can really help you to figure out the wheat from the chaff. The next part that you want to do is you really want to understand what exactly are you reading. In this case, we're looking at investment strategies, but it could be something like risk management or an investment process, something that's actually going to improve the way that you go about investing. As you're starting to dig a little deeper into the paper, you want to ask yourself, why is the author writing this paper? What is their motivation? Why on earth would this particular author write this? Where are they coming from? Are they writing this because they want to show something? Are they wanting to disprove something? Do they have some sort of political agenda? Because that's going to impact the way in which they set up the problem, and it's going to impact the way in which you read it. Not every single academic paper was written with an investment professional audience in mind. In fact, most of them aren't. In fact, one of the papers today was written by a professor, the other was written by industry professionals, and both of them are not necessarily geared solely at getting you to invest in a strategy. So you need to think about the author and their intended audience and how you can adapt that to your particular needs. And then you want to start thinking about what are the main innovations, what are the main ideas in this paper? Why is this paper interesting? And that's usually going to be somewhere in the conclusion, if you're lucky. If not, you're going to have to do a little bit of digging, or you're going to have to ask some questions yourself as you go along. And that really brings me to the next part. These are the questions that you want to think as you dive deeper. And these, once you go through the papers that are in front of you, you're going to start to want asking these questions as you prepare for the Shark Tank. Can you describe the main concept or statistic in the paper? Are you able to recite back how this paper works, how they construct the idea, how they go from concept to implementation, and what the key findings are? If you're not able to do that, then you can find yourself in a situation where either you didn't spend enough time reading the paper or getting into the details of it, or possibly, and this is a lot more dangerous, the author themselves didn't do enough of a job setting up the problem. You want to be able to separate out those two. So you want to see if you can actually start to poke holes in the paper. And that's really where the critical eye starts to come in. And this is a sort of difficult mindset to get into. You invest a certain amount of time in a paper, and psychologically you want it to be a good paper. I've already invested an hour reading this paper. I want to find a good application of it. But you want to start questioning it. What are the limitations of this? What have they left out that you didn't think about? Does it have backtests? Is there something that you would exist in the real world, like transaction costs, that they didn't consider? That's not necessarily a dead end for it, but that's something that you want to understand as you're reading through. There's going to be things that they glossed over to make this work, and you want to go and act as if they're trying to hide something. Now, these authors are really focused on proving very simple academic concepts, but in order to think about this at the next level, you want to think about what is it that they are leaving out. And that's where your friends and colleagues really come invaluable. And this is this last point, and this is where we get the idea of the shark tank. It's one thing for me to go through a paper and to question myself on what I'm reading, but it's yet another thing to really get in there and start questioning these ideas. Present this idea to somebody else as if it's your own and see what feedback they have. They're far less vested in that idea, and so they're far more likely to give you honest feedback and honest questions. They may think of something that you haven't, and that's exactly why we do the Shark Tank. My team has been doing Shark Tanks for a number of years, and we let our junior researchers come in and bring along an idea as if it's their own and present it to a ruthless set of sharks, industry professionals, strategists, investment managers, and really put them through their paces, not as individuals and the presenters, although that is important, but really as their ability to stand behind an idea and present the idea with all of its strengths and all of its flaws to the Shark Tank. So I'm going to move now to the interactive session. I've given you just really high-level insights into how to read the paper, but really this is now the point where I want you to start to get involved in this. If we can bring the house lights up, and if I can have my colleagues from State Street raise their hands and just identify themselves as facilitators. There should be one at most of the tables. If you don't have a facilitator, you can play along by yourselves. You should find copies of, as I said, copies of the paper. There is a summary sheet that you need to fill in, and there's also this analyst report on each of the papers that is got all of the details that helps you to go through that. So we've got about 20 minutes here. You want to go through, you want to start reading the paper, probably take the next couple of minutes to start reading, and then I'm going to walk around and check in on you, and then we'll bring it back in and we'll do a presentation. So jump right in. Let's see. Okay, pencils down, everyone. How do we get on? Everybody do okay? So we're going to move on now to the Shark Tank period. So hopefully you've all thought about how you might want to pitch, and maybe a couple of you even want to volunteer. As you're thinking about whether you want to volunteer, if I could ask David Hartley to come and join me on the stage. Give a round of applause for David for joining us today. Now, you've also already seen David on the main stage earlier today, but David is the director of the Australian Catholic Super and Retirement Fund. Sit down any way you want. And so let's get started. Do we have anybody who wants to pitch quality minus junk? You'd like to give it a go? Absolutely. So we'll bring you up in a second, and you can present from the podium. Anybody for geographic momentum?
Good on you, Michael.
Nope. Oh, we've got somebody over at the back here. So let me explain a little bit about how the process is going to work. So we're going to do I'm going to give you a little bit longer than 90 seconds and 3 minutes, but the idea is you have 2 minutes to really get across the key of the idea. Tell us why this paper is interesting, why it's valuable, and for those 2 minutes, we're not going to interrupt. We're just going to sit here and listen to those ideas. But then as soon as those 2 minutes are up, the tables are turned. We are going to question you, to grill you on this paper and really sort of try and get to the bottom of the idea. And there's really only one rule for Shark Tank, and that is that we are evaluating the paper and not the presenter. Now, sure, presentation style matters. It's important how you pitch an idea. But really, when we're evaluating ideas, it's not so much about the style and the convincingness of the argument, so much as the content of the paper. So we're really going to be thinking about the idea. And that's something that I really stress in my teams when I do this back in the US. So let's start with quality minus junk. If you can introduce yourself and then briefly give us your pitch.
Good afternoon, everyone. I don't have a death wish here presenting when my boss is on the next table. But I'd like to talk to you today about a brand new discovery that we found in relation to factor investing. As you know, there are many firms who've been data mining, and if you torture the data long enough, you can get it to tell anything you want. And we've found a remarkable discovery in backtesting data, and that is, in the past, everybody knows there are factors that work: small cap, value, momentum. The English from York know that there's 100 years of history in momentum. The French knows this. They had to outdo the English, so they found 200 years. And we found a brand new factor, which we're going to call good shares. And in order to make you want to buy it, we just don't call it, here's a factor that works, we just don't call it XABC, we call it quality minus junk. So basically, if you add the good things and subtract the bad things, it will improve your portfolio. And why is this important? Because you can get all the benefits of certain active managers and all the additional return, which we'll call alpha, even though it's just a systematic beta, by taking a market, dividing it up into chunks, and then systematically rebalancing so we have this quality minus junk factor. Now, I see there's some asset consultants in the room. I saw Mr. Marshman before. And the most important question he's going to ask me is, why is this different from any of the stuff that people have pitched us in the past? And the most important thing about this is that A, it works, B, it can be added, so it's additive to the sort of models that Dimensional and the 4-factor models that they do, so you can have this as well as those. So instead of just having small cap value skew, you can have a small cap value quality minus junk skew. And instead of making 3.5% per annum over large caps over the long term, this will get you to about 5%. So quality minus junk is worth about an extra 1.5% per annum. Now, the questions that I might be asked is it correlated, or is it just another expression of some other factor inside the data? And the answer is no. It is negatively or uncorrelated to small caps. It's negatively or uncorrelated to value, and therefore, in the hunt for finding ever more uncorrelated factors, this makes a really nice addition to your portfolio. And as I said, best of all, you can go to your favourite propeller head and say, just add it to the menu, and off we go. That's pretty much...
Thanks, Michael. So let's find out a little bit more about this paper. Let's figure out whether this paper is mainly quality or mainly junk. So we've got a couple of questions here. I mean, the first one is, we've been doing factor investing for decades now, trawling through fundamental data. And this paper isn't even necessarily coming up with new fundamental factors. They're just packaging them into one whole. So what is it about this paper that is interesting versus everything else that's come before it?
Well, the most interesting thing about this factor is the small cap value skew hasn't worked for 7 years, and this has. Additionally, this factor is something that was in the past not known, so I challenge your view that it's something that isn't different. This is actually a new factor that we haven't been able to do before. And there's been always a great debate as to whether high vol, low vol works and what it is. And the best research that we've done, and we've tried to create a null hypothesis and controlled for every other factor, and we found that it's a combination of adding high quality stuff, but mostly and most importantly, it's excising the low quality junk at the bottom of your portfolio. Do those two things together, as I said, additive about 1.5%.
Michael, I was just looking at the data in the paper, and I just noticed that in the late 90s, when we know that junk tech stocks did really well, this had a drawdown. It didn't seem to be much of a drawdown, and then it sort of, it really took off in the subsequent period, which is what you'd expect. But what sort of circumstances do you think that this factor wouldn't work, and what sort of magnitude and duration might we have of a drawdown in terms of being able to maintain the strategy in the face of that sort of circumstance?
Well, looking back at the data, remember that part of the data collection is limited by what's available in certain periods. We've noticed that over long periods of time, using monthly data, it's uncorrelated, but certainly over certain periods, it is very badly correlated with what might happen. So in 2009, as an example, when we had the world's greatest shit rally, you should wear it as a badge of honour that you'd underperform in that time. The value managers said we outright are buying junk, it's just cheap junk. So in that sort of environment, you'd expect quality to underperform, and quality factors like QEP, etc., did that.
Yep, excellent. So one last question. So this paper is written by a number of industry professionals. And really the sort of final question is, why write a paper that basically gives everybody a recipe book so that they can invest in a strategy without needing to come to you for the answers?
As somebody who likes to go to the racetrack, I was always told those that tip don't know, and those that know don't tip. So it's a good question that you ask, is why should I do that? It's probably for the same reason that people write self-help books on how to make $1 million in property, because the best way to make $1 million in property is to write a book called How to Write $1 Million in Property. And if you look at David Booth and Dimensional and the two winners of the Bank of Sweden Prize in Economic Sciences, they've made a lot more money without any recourse to them or without having to put any of their money at risk, just saying, use my four-factor model. So that's why you do it, because funds management return on equity is 77% and still a whole lot better than putting your hard-earned in.
Okay, thank you. Give Michael a round of applause. We can have the next presenter come up to the stage and present. Do we have somebody wanted to present, or we got a? Oh, do we got to see this? Give him a round of applause here.
I have a health warning for our presentation, which is our table found the long description quite complex, so most of our assumptions were based on the short description, which we found much easier to understand. Our theme is geographic momentum, and in terms of helping you understand the innovation in this paper titled Geographic Innovation, the main assumption is that Americans actually do know something about geography and foreign markets, which is quite groundbreaking, I find.
That's unbelievable.
So if we hold that assumption and that innovation to be true, why wouldn't you follow and deploy money long into into markets where American multinationals are deploying their capital into countries that have good momentum, and short those countries and/or corporates that are deploying their money into countries that have bad momentum? So the idea there is go long the top 20 momentum countries and those multinational stocks that have a lot of exposure to those countries with good momentum. We can talk offline what defines good momentum in terms of countries, and go short the bottom 20 momentum countries, and those U.S. multinationals have a large portion of their exposure to those countries. So it's a long-short trading strategy, and the idea is follow the capital flows of large U.S. multinationals. Our strategy performance is undetermined. We think you have a 50-50 chance of losing money and/or making money, and the potential concerns about this paper we think is the innovation assumption correct?
Okay, well, thank you. Round of applause. Great pitch. So now we get to figure out whether this paper has enough momentum to get it across the finish line, or whether it's going to quit halfway around the track.
So Greg, what's the quality, the data quality like? Is it hard to get?
Well, it's largely based on the Morgan Stanley MSCI Global Equity Index. That's the breakdown in terms of the countries that we are building the model off in terms of where there's momentum or lack thereof momentum.
Do we have a lot of faith in that data, or is it?
Depends on the country. Places like Russia, maybe less so, or Hungary. Countries like perhaps Australia, huge confidence.
But we don't often get that sort of segmented data, like to give a really good idea about the exposure to the different countries. It's a bit dodgy sometimes.
I think you're probably right. That's my prediction of a 50-50 chance of making money or losing money.
Right. We had that question that came up about whether using the entire market as a proxy for the performance of a multinational that's likely a single sector play in any given country is a reasonable proxy. Any thoughts on where that could go completely pear-shaped?
Not really.
Fair enough.
The long description wasn't long enough.
Actually, do you suspect that it really is only for US multinationals, given the richness of the data, or the data?
Yeah, I think it is. That's where it is, and it's effectively a momentum play, saying based on your model of where there's momentum in an economy on a whole, and looking at those US multinationals that have a large exposure to that economy with momentum. You're effectively saying, all right, we're going to ride that momentum that the market may not yet be picking up because they don't recognize the percentage of revenues that it contributes to that U.S. multinational. But it's quite macro. It's at a country level, not at a sector level necessarily. So to your point, that it may get lost that may get lost in translation.
You could actually get some unintended sector biases, maybe.
That's probably right.
Possibly.
Yeah.
Yeah. So the final question we have here is this seems like a strategy that relies on the ignorance of the masses. And if everybody in this room went away and traded that, doesn't the signal just disappear?
Yes. Yes, very good questions.
That's the idea.
No, I think that's right. The public markets are so well picked over that information asymmetry is hard to come by.
Yeah.
That's why you should go to private debt markets. I shouldn't have said
All right,
that.
well,
Yeah.
Thanks very much. A round of applause to both Michael and Greg. All right, so now we're going to turn to the voting session. So we've heard two compelling arguments for two papers, and if you can go to your apps, there's an opportunity. Polling question number 2 on there gives you the ability to vote for one paper or the other. It also gives you the ability to vote for both papers or none of the papers. But we're in a Shark Tank here, so we're going to go for the kill. So I'm going to encourage you to pick one of the papers or the other, and we're going to see which paper we like best. So we had two compelling arguments. First, we heard about quality minus junk, a strategy that provides persistent outperformance by identifying a way of separating high-quality stocks from the rest of the pack, and then geographic momentum, a strategy that shows the value of incorporating information from foreign markets into the performance of investment decisions for local market stocks in the US. So let's see how the votes are coming in. All right, here. So we have a significant bias towards quality minus junk. I think it's going to be very difficult. In fact, neither is beating out geographic momentum. I feel very, feel very sad for geographic momentum there. And I mean, this isn't entirely surprising. I mean, quality minus junk is a nice intuitive idea. It makes sense that we would want to hold quality stocks and be able to sort of identify something that can really separate stocks that have good pedigree. And often it's an intuitive idea that really drives the decision. If we can just go back to my my last slide. Last slide there. Really, the ability to pick a nice intuitive idea and be able to explain that can be a good way of demonstrating to our investors, to the people that we are investing on behalf of, that we're able to evolve our thinking. And so something like this is a great opportunity to do that. So I hope you enjoyed this session. I'm just going to go back to the final slide and wrap up here. This session is really designed to be both educational and hopefully enjoyable. Hopefully you're able to get something out of it and learn a little bit about how to tackle academic research. It's a daunting process at first, but once you actually understand what's involved, you start to get into a routine of how to tackle a paper in speed. In the space of 15-20 minutes, you're able to get a decent gist of what to do with an academic paper. And academia often finds ideas before the rest of the investing world catches on. And so staying close to the cutting edge ends up being an important part of our role as investment professionals, even if we're not necessarily the ones that are going to implement this. It could be that understanding these ideas is useful in our conversations with investment managers who themselves may be looking at implementing it. Now, I mentioned a little bit about what the approach that my team takes. We use this combination that we call Quantextual, where we have a focus on machine learning, where we're actually using machines, we're using IBM Watson and things like that to actually help us figure out which papers we should be focusing on. But then we're also leveraging a team of research professionals. I have a number of PhD students working for me on an ongoing basis, doing the first round of evaluation of these ideas to really sort of keep this process going. And what that ends up doing is giving you an opportunity to really sort of leverage both the discipline that we have here as well as the scale that you can get from bringing in technology to bear on this project. So I'm going to be around for the rest of the conference and the dinner this evening. I'm happy to sort of talk to you a little bit about the philosophy of how we go about this and what it sort of means to get into a really rigorous approach to not just evaluating one or two papers, but really sort of trying to find a nice diverse set of ideas, because each of these ideas is something that can start off that investment process. Again, these ideas are fuel for new investment strategies. They're fuel for sort of diverse thinking. And by throwing ideas into the midst of a group of people, it's certainly within my team helped us to come up with more innovative ways of approaching markets, even if we're not necessarily just implementing the first paper that came along. So I'm going to finish by suggesting that you keep reading academic research, keep pushing the boundaries of your knowledge by forcing yourself to look at ideas that may be complex at first, but maybe you can find some insights and figure out how they may apply. Because in this environment, we all need to swim a little faster as researchers and investors, particularly when you are trying to swim or outrun the low-return sharks that are continually on our tail. So I'll pause right there and open it up for any questions that anybody has.
I've got a question.
Absolutely, go ahead.
So if you think about the sort of the academic literature, obviously there's a lot of things that aren't immediately apparent that there's relating to finance. I'm reminded of the oil shale and those sorts of things. There's academic papers about them probably 2 or 3 years before it became a popular thing. Do you ever sort of look at those sorts of things for maybe sort of ideas which are sort of off the radar of other people?
It's a tricky thing. I mean, that's a very delicate balance. The question of, do you focus on the mainstream? I mean, obviously there's a lot of papers written about US large cap equity investment strategies, and then there's a million different directions that you can go into. And so what we tend to do is we do tend to focus a significant amount of our effort on the mainstream, looking for new approaches for highly scalable strategies, but we will tend to look around to see is there an emerging theme? Are we seeing stuff coming in the periphery that we could maybe actually devote an entire quarter to looking at? So in addition to looking at everything new that's come out in a quarter, we'll typically take a topic and look back a couple of years, see what we can find, what's been written on quantitative applications of private equity. Where is academia at with creating factors around ESG? These are all the sorts of topics that I'll typically have half my team work on the mainstream, and then have a couple of people working on on a topic of specific deep dive.